Good afternoon and welcome back to the latest edition of the InvestTalk Market Analysis for the week ending June 27th, 2025. I'm host of InvestTalk, Justin Klein. Appreciate you all tuning in to this channel, liking and subscribing and hitting that notification bell. Now, this week I'm titling the video, Will Momentum Hold or Will the Breakout Fail? And that's the big question here. And we'll dig into kind of the hints that will go one way or the other. But this is the broader market for the week. What you can see here is overall, you had green outside of energy, which obviously the tensions in the Middle East have calmed down a bit for the time being. I doubt that they hold forever, but we'll probably get more issues, I think, by year end. But for now, that tension has calmed down. So overall, a nice broad-based rally at or above new highs for most of the major indices. Now, what I want to get to is this. Let's look at the performance for the week. You had the dollar index that was down, S&P up about 2.8% on the week. You had the Dow up 3.6. I'm not sure why it's not giving me the NASDAQ here, but that was obviously green. You can see the sectors. You had financials leading the way along with industrials. Consumer discretionary had a good week along with the technology space. Energy obviously down 3.5%, real estate down 2%, communication services up 3%, and materials and utilities kind of middling there. So that was the market for the week. Bitcoin up nearly 4%. What else did you have? The euro continued to appreciate against the dollar, 2%. British pound the same. And the dollar was down compared to the yen by about 0.5%. So gold, interesting enough, it was actually down 2.7%. It had a nice pullback on the week, but I'll show you on the charts. Not much to worry about technically there. But let's dig into the economic news. And we had existing home sales on Monday. That was about flat. We're kind of still hanging in this 4 million range. So the home market isn't getting worse. It's not getting better. It's just kind of staying at that low level of transactions. Richmond Fed Manufacturing Index, that did tick higher a bit, but still in negative territory. New single-family homes sold. This one disappointed in a big way. The expectations were closer to this, a tick down, closer to the 700,000 mark, a little lower as expectations, but we were closer to the 600,000 mark. So clearly the new home market is struggling, and that's not good for the home builders. You had pending home sales, though. This was in May, so it depends on which ones will close in June. But so it's a little bit lagging, but you can see it's up 1% year over year, and you can see for the past year it's just been kind of hanging around this flat line. Not a great housing market overall. You're definitely seeing inventory rise in most markets, and you're starting to be in many markets. You're getting a buyer's market versus what had been a seller's market for a long time. Now, the most important data on Thursday was, or the whole week was on Thursday, and that was the continuing claims and initial unemployment claims. And I've been talking about this. The labor market does look like it's breaking to a degree. Not fast, but certainly what I saw or what I heard from colleagues in the business world, kind of post-Liberation Day, May, April, and May timeframe was we're not hiring, but we're not. We're not laying off people, but we're not hiring either. We're going on a hiring freeze. And that's kind of what you've seen here. This is a 3-year chart. Let's zoom in. This is the initial claims for unemployment. What you can see here is Liberation Day back here. Okay, right before the week before Liberation Day. And, it was okay for a few weeks. And then it started to tick higher from, this was in the 200,000 mark. This is how many people are getting laid off, right? How many people are filing for unemployment claims? And going from about 225 and steadily trended higher up to about 250. So about a 10% increase in layoffs over a couple months. Now pull back here, 236, and it's back to reasonable range. That's not really too much of an issue. But this really is, and this goes to a 1-year chart. And you can see, actually let's go back to a 3-year. What you can see here, I didn't want to do that, is that this has been really chopping sideways. This goes back to summer of last year. We're kind of in that 1.85 million mark for a long period. And then let's zoom to 1 year. And then what you can see is post-Liberation Day here, this started to trend higher, right? By the end of April, we were at 1.87. By the end of May, we were all the way up to 1.95. And now in June, we had a good little tick down, but now it ticked back up as of mid-June to 1.97. 2 million to me is the mark where it's clear the labor market is broken. And in a lot of ways, this is self-fulfilling. Because remember, or it's reflexive, shall we say, is when people get laid off, what do? They tend to have less economic activity. They go out to eat less. They travel less. They go buy less things. Everything you would imagine someone who just lost their job would do. Kind of retrench in their spending. And what that does is it creates less job opportunities in the marketplace and adds to the odds more people will get laid off, because incrementally that's more people that are tightening their belts. And so if this continues to go, this is the labor market breaking. It will feed into economic activity, profits, etc. Okay, so I wanted to highlight that because that's definitely the most important. I'm watching that like a hawk to see if there's any change to this, and right now that's all I see. Now, that isn't saying everything's going to hell in a handbasket or anything like that, because there are some things that are especially holding up this market. And I'll talk about that in a second. But let's get lastly to core PCE. That did tick up a little bit, 2.68. I do expect inflation to accelerate that in the back half of the year. Not dramatically. We're not going back to 8 or 9% inflation or anything like that. But, get back above 3 by year end. I think that's certainly possible. And you had a little bit of evidence of that in May. But we'll get more as we go through the second half of this year. And, it's not 2. It's not what the Fed is talking about, right? Which is their target, which is 2. And now when it comes to why the markets are, at new highs, really, there's a couple of factors here. M2 money supply year over year continues to be pretty solid, up 4.5%. Now, it did kind of chop sideways this last week, but overall, it's in a good place. Okay. And then you look at here, big reason for that is commercial credit. Commercial banks growth is still going up. It has leveled off here in the 4.5% range. We'll see if this gets a rollover like we did back in beginning of the end of last year and into the beginning of this year. But ultimately, this will tell us what's happening with liquidity. Or the commercial banks are the ones that produce or create dollars a lot more than the Federal Reserve. Okay. Now, speaking of the Fed, I want to emphasize this, that the rate on the Fed funds rate is a bit overemphasized, and people think it matters more than it does in today's environment. Now, 30 years ago, it definitely mattered much more than it does today. But as time has gone on, what the central bank is doing with QE, QT, et cetera, that's more important to what's happening with liquidity, keeping the treasury market solvent, all of that, especially with our debt burden that we have right now. And it's pretty clear, President Trump is going to try to put in a de facto Fed president nominee early to try to have them jawbone maybe the market's down and juice the treasury market and get not force him to get rid of Powell, but neuter him in a way. And I think that will be interesting to see how that plays out. But ultimately, the Fed is meeting at the end of July. There's a very good chance they don't do anything. September is probably where they cut. I think that continues to be where the preponderance of evidence is that they'll get enough data. The big question is, where will inflation rise faster than unemployment? I think is a big question. And frankly, I don't know. Obviously, let's go to unemployment. There's a U.S. unemployment rate. Let's go here. We're going to go to the original. You can see how correlated this is, right? So this is the continuous claims, like I said before, and then the unemployment rate. And historically, they move together. Look at this, right? So if the claims are rising, right, it's fair to say that the unemployment rate will also rise. Okay, you see how correlated they are. Depends on what time frame you want to look at, but clearly they lead, right? You can see back here is a normal kind of recession, '07, and actually, I wonder if we can go to. Let's do that. Let's pick like 2005. We'll just do January. Then let's go to 2011. Okay. So you can kind of see that, right? You see this correlation. Um, Unemployment rates stayed higher, and continuous claims came down. Now, eventually, what happens here is the reason at the end of a recession, it actually breaks apart is because you can only get unemployment for so long, right? And so a lot of those people who stay unemployed, they come off the unemployment doles, and that's why this purple line falls, and the unemployment line doesn't. That gap is how many people really are unemployed and not collecting unemployment anymore because they've exhausted it. But what you can see is in a recession or heading into a recession, you get that strong correlation because most of those people are very new to the unemployment doles, and so they haven't exhausted their unemployment quite yet. So that's what you see here, and I wanted to highlight that kind of uh, as a primer for what happens and how this kind of leads the unemployment rate higher. You can see that initially it always is a bit higher than this rate. So I just wanted to touch on that because it's very important to understand that correlation, and we are going to see an uptick in unemployment over the next 3-6 months. It's just a matter of how does the Fed balance that with what is likely also going to be higher inflation. Now, once again, not crazy inflation, but certainly probably an uptrend. I think unemployment and inflation are going to uptrend between now and year end. And it'll be very interesting to see how the Fed kind of reconciles that, deals with that. They have 4 meetings left. Market's kind of expecting cut in September, cut in December, and that probably feels right for the first time in a while. I don't think the market's been very accurate on the Fed for a little while, and to me, the first time this feels kind of right. Now let's pivot over to the charts. Here's the NYSE, and what you can see here is we're basically trying to get to we're at a new high, just barely. Momentum is not great. MACD, you're seeing some divergence there. Let's go look at the Nasdaq. COMPQ, right? That's at new highs as well. Same kind of thing. The MACD's not great, and we're getting overbought here. You move to a weekly chart, you had that sell off, and this is clearly in overbought territory. So I think at the bare minimum, we get some sort of consolidation, modest pullback in the month of July. There are some quarter end option positioning that's kind of keeping the market, I think, buoyant through the end of the month, which ends on Monday. Tuesday is the 1st. And so I think you could get more volatility around that, especially after the holiday, 4th of July holiday, which is next Friday. I think that will be a potential modest turning point, not anything where the market heads right back down, but something to where we start to work off this overbought scenario in a more material way. You get more volatility, et cetera. We're also running into, I think it's the July 9th deadline on tariffs. Obviously, recently Trump has said that he's not liking how it's going with Canada and kind of playing hardball with them. And the whole taco trade. Remember the whole taco? Trump always chickens out. And I think with the Iran thing, part of it was kind of showing everybody that he's not chickening. He won't chicken out, and I think he still wants to regain some credibility on the trade front as well. So I do think that he will be a bit more hawkish than he's been recently. So this is why I still continue to think this is a choppy environment. I think we get more eventual sell-offs, maybe not the exact magnitude of what you got in earlier in the year in Q1, or sorry, I guess it would be beginning of Q2. Crazy, lots happened this quarter, but this is a period where I do think we get a lot of sell-offs, you get big rallies. This is the first half of this year is I think going to look a lot like the back half of this year. It's just a matter of, when do you get that volatility to ultimately rise. I do think it does start to pick up here in July and August, and September is obviously a month as well where you get a lot of volatility. So the third quarter does tend to be a not a great quarter, probably the worst quarter for markets in general. And especially as you get into the back half of the quarter. So very interesting times, I think, ahead. Doesn't mean we can't continue to make new highs, into next year. A lot will depend on liquidity. A lot will depend on, Fed action. Um, and a lot will depend on what that stagflationary environment looks like and when the market kind of starts to pay attention to it. Right now the market's paying more attention to the Middle East, the Fed announcement, all of that. So that'll be very interesting to watch. So I hesitate to say that we're going to roll back over. I just expect more choppiness going forward. So that's kind of where we're at. Let's see. My charts have been kind of odd lately, so hopefully they start to give me, there we go. Okay, here's GDX. So I'll get into gold. Obviously a pullback here, but just to the 15 moving average, we saw that here recently. Remember, gold is now tier one capital for banks. So I still think there's a broader accumulation. This is just working off overbought, above overbought scenario back in April. The Barron's cover about gold usually is, from a sentiment perspective, means there needs to be a cooling off period, and that's what you've seen. And this continues to chop sideways there and just consolidate. So I think I see no issue. The dollar continues to remain weak. You saw that rough week this week. Could you get a bounce? Certainly, but in general, I think the dollar is headed lower for various reasons. Pricing in a more dovish Fed going forward, obviously more geopolitical instability, instability with our budget. That continues to be what's being trying to be pushed through Congress, and domestic instability as well. So I think there are a lot of factors that are moving people away from foreign investors, away from dollar-denominated assets, and that is likely to push the dollar lower. So that's where that is at. What else do I want to get to? Let's get to the move index. I always like to check in on this because it gives me a sense of what's happening in the treasury market. And there's no issues here. So no problems on that front. Let's take a look at SHYG to SHY. So this is short-term junk to short-term treasuries, and this is continues to heal. Right, the credit markets are healing. I continue to watch this though. Blackstone, Apollo, they did have good weeks. They're still overall technically not looking that hot. Most of these are still not making new highs. Recent new highs are still well off their highs. KKR has been the strongest as of late, but still, you're up into resistance here. So I frankly think these names could be at inflection points. The financials as well, not breaking out to new highs. So that's something I continue to watch and I think is important. The positive here is IAI, the broker dealers, they continue to do well. So I think this has to do with more the steepness of the yield curve. But the banks not doing so hot either. That still remains well off the high. So I still think there's a lot of underlying problems with the broader financial system due to the what's happening with private credit, private equity. I still think there's a lot of chickens that need to come home to roost, and I think they will over the next couple of years. It's just a matter of timing, and I think those are names that you certainly want to avoid, areas that you want to avoid. Let's take a look at silver. This is one thing I did not talk about. Silver is leading the way as well. That's good for precious metals in general. So the fact that that is doing well keeps me bullish on precious metals as a whole. Let's take a look at the bond market. So IEF. So here is the 10-year bonds. So are they dropping in price? It means this would be rising in price. Sorry, dropping in yield. This would be rising in price, and that's what's happened over the past month or so. We had that threatening of the breakdown of TLT below, I think it was the 85 level that we were worried about. It did briefly, but it recovered it so far. But this is really just a falling wedge, right, or a rising wedge, excuse me, which usually resolves to the downside. Pretty good volume on Friday as well. That was pretty interesting. So could you get if you the biggest worry to me is that in the I'd say the medium term is if Trump appoints somebody that the market doesn't like, that doesn't give confidence in the Fed, that the market thinks will just lower rates, issue everything on the short end, which would be inflationary, and blows out the long end, meaning long rates go up. I think that would probably be the biggest risk to markets over the medium term. Even a war in the Middle East, we've had that before. Frankly, that brings more spending. Usually, wars are more bullish than bearish. So I don't think that's as much a risk. Not that it doesn't have some risk to it, but I think what is more is, okay, what's the stability of the financial system and how much Trump's actions will risk that, and that is what I'll be watching for, and what the market reaction will be to any of those big changes that he could potentially make. So, yeah, that's what I'm. I still remain kind of neutral to slightly bullish on the market. It's liquidity is good. Uh, there are problems underneath the surface, like I said, with the labor market, with private credit, with a dollar that continues to be weak. But overall, once again, liquidity is abundant. And when that happens, asset prices tend to elevate. So until you see a major shift in liquidity, banks pulling back lending, the corporate bond refinancing, draining liquidity from balance sheets around the globe. Until those things happen, I'm not getting too bearish on the market. I think we're just more overbought, into resistance, and could probably see some choppiness in the third quarter that's tighter than what we saw in the choppiness in the second quarter. Okay? So that about does it. Appreciate you all tuning in, and once again, liking and subscribing to this channel, as well as our podcast, InvestTalk. And a reminder, the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell security or to participate in investment strategy. The views are my own and do not reflect those of KP Financial or those associated. Have a wonderful weekend.